Okay, here we go. Let's see if we can do problem 13-4A without too much confusion. First of all, we need to look at what we have in information about the company. We've got common stock, 20 par or stated value, 500,000 authorized, 375 issued. Has an overall worth of 7,500,000. We have paid in capital in the excess of 825,000. We've got retained earnings of 33,600,000. And then down here we've got treasury stock that we've bought. We have 25,000 shares, which actually means we have 375,000 shares issued, but we only have 350 outstanding. The cost, okay, of these treasury stocks when they bought them was 450,000. They've divided, and to find out the actual cost per share now when we go to sell these again, we divide the 450,000 by 25,000, and the cost of the treasury stock is 18,000. So those are things to keep in mind, and as we go through the problem, we'll come back to them. First thing they do is they paid cash dividends of 8 cents per share on common stock. It's been already recorded, and it's in a payable. So now we have to, we know the first entry is going to be that cash. We credited it for $28,000, and we have to take it out of the dividends payable. Now, what does that look like on T accounts up here? Well, here's my payable, okay, and it's been debited, and here's my cash credit, credit. So those two are good. Nothing else changes at this point. I've put numbers in here so it goes a little bit faster, so I'll point them out as I go along. Second thing we do on April 10th, we issue 75,000 shares of new stock at $24 per share. Remember, the stated value was $20. So cash, we're getting $1,008,000. Common stock is going to be credited for $1,005,000, and additional paid-in capital in excess of the stated value is $300,000. What does that look like here? Well, good golly. We're going to come up here, and the first thing, we've received $1.8 million in cash. You can see that right there. So that's our first entry. Second entry is we've got to record the common stock. It's 150,000, 1,500,000. And then we have paid in capital of 300,000 down here, if you remember that. One additional thing that I'm going to do here is I'm going to add that 75,000 shares to my actual account. Now, I've got 25,000 over here because we have those out on Treasury, remember? So I've just added 75,000 to the pot. We want to keep a running total on that. So that takes care of April 10th. Then on June 6th, we sold all the treasury stocks for $26 a share. Now, let's see, June 6th. So we got cash of 25,000 times $26 of $650,000. Treasury stock, okay, we've got to remove that. It was valued at $18. Remember the cost we figured? So that's going to be credited for $450,000. Now there's a discrepancy here. So this paid-in capital from the sale of treasury stock, this account is going to be credited. So now if you go, and here is our cash of $650,000. We've debited that. Here's our treasury stock. We've credited for $450,000. And here's our paid-in capital for $200,000. So we've recorded that into the T accounts. We also should come down here. Remember, we had, where is that little booker? We had 25,000 in here. We've removed them. Okay, and in essence, they're back here now. So if you add these all up, these two counteract each other. It's as if they never happened in a way. So now let's go back and do our next entry. So you can keep track of, we've got June 6th is out of the way. Now we're doing July 5th. We declared, and this is going to get a little bit confusing. Did I miss one? No, we're good. So now I have stock dividends, and those dividends are at 4%, and the market value right now is $25 for the shares. So that becomes our cost of the whole stock dividend. How many shares do we have outstanding now? Well, if you look at that actual T account, we have 375,000 plus 75,000 times the 4%. So that's how many shares we're going to, which is 18,000 shares, that we're going to distribute in the stock dividend times 25. So the stock dividends are worth $450,000. The distributable stock dividends, and we're taking that back to par, is 18,000 shares times 20. So that's $360,000. And then the paid-in capital in excess of par is the 18,000 shares times 25, well, the difference between the 25 and the 20, which is 90,000. That can be a little bit complicated until you really look at it step by step, like we did in the first explanation of the stock dividends. Let's see what that looks like over here. Now, what are we doing with this? We declared a stock dividend, so we're looking for a stock dividend, and it's a the first thing we did was the 450,000 to declare. We've got it there. This is what's going to be distributed to 360, needs another zero, doesn't it? 1,000. So, and now we need to do the additional paid-in capital, which is right there. So that's a balanced equation, or a balanced entry. So now we're down to August 15th. Let's go back to August 15th. We are going to distribute this. So we're going to have to take what is the dividends that are to be distributed and distribute them and put them in common stock. Again, if you go back to your T accounts, we're going to take it out of here and put it into common stock right here. And that lines that up. So let's go back, and now we're on November 23rd, and we purchased some more treasury stocks. And we purchased 30,000 shares at 19, and that was $570,000 and $570,000 in cash. So if we come back, let's go to here. So now what do we do with this? How much cash was that? We've got 570,000 there. We are going to move down to treasury stock, and oh my goodness, I lost it. We're going to debit that for 570,000. Remember that, I believe, is 30,000 shares. So now I've got to come down here, and I've got 30,000 here. Okay, remember I did a stock distribution? I should put that in there, shouldn't I? I'm going to remind myself that I have treasury stock here to come out, just so that I know when I go to do my financials that there's something over there that needs to be compared to that total. So let's go back. Now we've taken care of that one. And then on December 28th, we declared a cash dividend. Let's see, declared a 10-cent per share dividend on common stock. And how did that all come out? Well, let's see. We have a cash dividend, and we have to figure out our shares, don't we? Well, we started with 375. We added 75,000, and then we added that 18,000. And here's that 30,000 share in treasury stock. So that all taken together is going to give you the total outstanding shares, and you're going to multiply that times 10 cents, and you come up with 43,800 in cash dividends that you're going to pay for here and here. Now again, we'll have to go back to here. And, oh my goodness, where are we? We're at cash dividends, and that's here for 43,800. And we are looking for a dividend payable, and that's right here as a credit for 43,800. And then they want us to do, you want us to close the credit balance in the income statement, income summary account. Now, we know it's a credit balance, so let's go back, and this is a little, so now, if I want to get rid of a credit balance, I've got to debit it, right? So what would a credit balance in the income summary be, most likely? That's going to be net income. And that net income is going to be closed into retained earnings, because that's the turnover. So let's go do that right now. So we have income summary that I'm going to debit for 1,125,123, and I'm going to put that in to, that's my net income, the retained earnings. And then close the two dividend accounts to retained earnings. Well, what are they talking about, dividend accounts? Well, let's see. I've got a dividend account here, and that's my cash dividends, okay? And do I have any in stock dividends? Let's see. That's a distributor. Boy, I don't want that one. Oh, here's one. Here you go. There's stock dividends and cash dividends. We're going to close those out. So where do you think you might close those to? Retained earnings. So let's go back and look at the sheet so you can see what we have to close. So now, to close these, we've got to credit them. So we're going to credit them for 450,000 and 43,800. That total is 493,800. That is going to reduce retained earnings. So let's go back. Now, you think I'm crazy because I'm making you do T accounts, but you're going to need this. So my retained earnings, let's see, what was that? My stock dividends here need to be closed. And here. And that's all going to end up coming down here for 493,800. And now you have T accounts. We should have a fairly good count of what we have out in actual accounts here. So let's go back to here, and that leads us, those are our entries that you have to have. That then allows you to create the retained earnings and the stockholders' equity reports. So I'll do that in another video so it's not so long.